The idea of retirement can be both nerve-wracking and exciting, depending on where you're at in the journey. For those of you that are started early and have a long runway still, you may be focusing more on dividend growth, and you can also take the hiccups in the market. But those of you that are nearing retirement may be looking for high yield investments right now and don't have the opportunity to take more risk or don't want to take more risk right now. However, if you are watching this video, odds are you're already investing or looking to start investing, and that puts you ahead of the game of many investors out there. The US Consensus Bureau did a study back in 2020 that found that the average baby boomer, only 58% of baby boomers right now who are nearing or entering retirement have retirement accounts set up already. That leaves another 40% that actually didn't even think about retirement. And like I mentioned, if you are nearing retirement, odds are you're looking more for income, higher yield investments. And in today's video, we are going to look at 3 different types of investments that you can invest in, all giving you higher yield. And all 3 are very different. So with that being said, let's jump in. Hey everyone, Mark here, back for another video. And if you are new to the channel, make sure you subscribe so you are notified anytime we drop new dividend content. And make sure you hit that like button, as it really helps the growth of this channel and I truly appreciate it. Before we begin, I want to send out a huge thank you to The Motley Fool for sponsoring today's video. If you go over to fool.com/Mark, you could sign up and receive their top 10 stocks to buy now. All right, let's take a look at these high yield investments, all of which pay high yields and are very different though. The first one we're going to look at is the Series I bond. The Series I bond is issued by the federal government. This is going to be the lowest risk option that we're going to look at today. The Series I bond updates its interest rate twice a year, in May and November. So we just went through an update, but folks that bought the Series I bond prior to the end of October were receiving an interest rate of 9.6%. Now that interest rate has dropped, but it is still a very high yield, especially for the lack of risk. Currently, if you bought a Series I bond today, you would receive an interest rate of 6.89%. This interest rate will stay unchanged through April of 2023. The Series I bond has 2 different types of rates connected to it. It has a fixed portion and a CPI portion, or an inflation rate. The fixed rate is very low, and the CPI rate, or the inflation rate, is what adjusts twice a year, and those are tied to CPI readings. Right now we're in a very high inflationary times, which is why it's created a high interest rate for investors. Given that the interest rate is tied to inflation, these Series I bonds are a great hedge against high inflation. You can buy Series I bonds through the government's Treasury Direct site, which I will add down in the description below. The second high yield investment that we're going to look at today is an ETF. And we're going to look at the JP Morgan Premium Income ETF, stock ticker JEPI, or also known as JEPI. JEPI currently has roughly $14 billion of assets under management, and the ETF pays a monthly dividend. The annual dividend currently sits at $6.02 per share for a dividend yield of 11%. This ETF has those looking for high income written all over it. The strategy behind this ETF isn't to just buy high quality dividend paying stocks or high yield dividend paying stocks, but they also are looking to sell covered calls against them as well. This is a way to juice that dividend even higher. Here's a look at some of their top 10 positions. United Health, The Hershey Company, Progressive, ExxonMobil, Bristol Myers, AbbVie, PepsiCo, Eli Lilly, and Coca-Cola. Selling covered calls is an option strategy that I utilize myself. It is considered a lower risk option as it pertains to options investing because you are leveraging positions that you already own. However, there is some downside to covered calls, meaning that if a market rips higher or an individual stock rips higher, your upside is capped at the predetermined strike price. So let's say you own shares of stock A at $30. You sell a covered call at $35, so you will receive an option premium. But if the stock price moves above that $35 rate, your income is capped at that $35. So if it goes up to $40, you are still capped at the $35 predetermined strike price. So that is definitely something to keep in mind, but it is hard to argue going against an 11% dividend yield that is paid out monthly. So now we've looked at a bond investment, we've looked at an ETF investment, and the third type of investment we're going to look at is going to be an individual stock. But before we do, I want to tell you about a special promotion going on over at Webull. If you sign up for a new account using my link in the description below and deposit any amount of money, they will give you up to 12 free stocks valued up to over $30,000. So definitely take advantage of that special promotion. Again, the link will be down in the description below. All right, now let's get to the high yield individual stock. And it happens to be a REIT, or a real estate investment trust. And that REIT is WP Carey, stock ticker WPC. WP Carey is a net lease REIT with a diversified portfolio, having properties in the industrial sector, warehouse, office, retail, self-storage, and other areas. The company has a market cap of roughly $16 billion. Going back a few years, we can see how WP Carey has evolved. They used to be very exposed to the office sector, and as we've seen, the office sector has really struggled, especially in these post-pandemic times. But that is not the case anymore. Now roughly 50% of their properties are tied to the industrial and warehouse space. Currently, the REIT has 1,428 properties that are leased out to 391 tenants. They have 175 million square feet of leasable space, and their annual base rent is $1.33 billion. They're also very diversified geographically, with 65% of their annual base rent coming from within the United States and the remaining 35% outside, over in Europe and other countries. They also have a long weighted average lease term of 10.9 years remaining and a high occupancy rate of 98.9%. Here's a look at the company's top 10 tenants, and looking at it, you can see that no tenant makes up more than 2.9% of annual base rent, which speaks to their tenant diversification. 99% of the company's leases have built-in rent escalators, with 55% of those being linked to CPI, and with inflation still high, this is a tailwind for the company in the near term. The company pays an annual dividend of $4.24, which equates to a yield of roughly 5.4%. WP Carey has paid growing dividends for 24 consecutive years now, having them on the verge of becoming a dividend aristocrat. So there we have it, 3 totally different options, all giving you high income. You can have the safe Series I bond that'll give you over an 8% yield, or you can look at the JEPI, the JP Morgan Premium Income ETF, giving you an 11% dividend yield. And then lastly, there's an individual REIT with WP Carey giving you over a 5.4% dividend yield as well. So 3 great options. Let me know down in the comment section below which of these you prefer and which one you like best. And if you are looking for more stock market information, then definitely check out my Dividend Investors Edge newsletter, which I send out weekly every Monday morning before the market opens, and it's completely free. With that being said, I hope you enjoyed the video. Make sure you smash that like button down below, and we'll see you in the next video. Take care.